Ladies and gentlemen, welcome once again. In this video, we will discuss the income statement. This is one of the most common financial statements that you'll encounter when doing your research on a company's stock that you either own already or are considering purchasing. The goal of this video is to provide you a basic understanding of what the income statement includes, how the components are assembled, and how to view it as you make your investment decisions. The income statement is the company's reporting of profits. It includes revenues, which are sales, subtracts costs, and the resulting number is either a profit or loss. Sometimes this report is referred to as the profit and loss statement or P&L statement. Companies provide investors this income statement following each calendar quarter and for the year. Some companies operate on a calendar year basis, but some use a fiscal year, such as July 1st through the following June 30th. A company typically uses a fiscal year if its operations are seasonal and feel their report will more accurately reflect their performance if the reporting year does not divide an operating season. Examples might be a ski resort that would likely choose a year that begins perhaps in the summertime so that an operating fiscal year includes the entire ski season and does not divide as would a calendar year that runs January through December. Likewise, a summer resort might prefer to state their operations on a calendar basis since January to December year would include their full summer operating season. A typical income statement is formatted to show each component of income and expense that leads the company's profit or loss, which is now as net income on the income statement. Let's see how that might look if we were in business of making and selling cupcakes. We'll assume that we sold $30,000 worth of cupcakes this period. Our direct costs for making those cupcakes were $16,000, leaving us a gross profit of $14,000. After the costs of developing new flavors and products, and all our salary and overhead costs, we are left with earnings before interest and taxes of $6,500. We have interest to pay on a bank loan that reduces our profit to $4,500, and that is pre-tax income. Income taxes are $1,500, leaving us a net income or net profit of $3,000 after all expenses are paid. Obviously, a major international corporation's income statement will be more complex than our little cupcake shop, but its correct income statement will be organized in exactly the same way, and the terms will be the same, so they are parallel. Let's dig deeper into this subject by examining each of the components of the income statement in detail. Net sales. Sometimes this is referred to as total revenue, sometimes as revenue from operations, and sometimes just sales. This is what customers pay to the corporation for its product or service. Most of us investors focus primarily on the bottom line, or the net income or profit. However, the top line, the sales revenue, is where profit begins. As companies grow, they become more efficient in their operations so that profits flow commensurate with sales revenue. Thus, profits are a direct result of sales growth or decline. Cost of sales. Sometimes you'll hear this referred to as cost of goods sold or cost of services delivered. Regardless, it's the costs associated with generating the goods or services that are sold to customers. In the manufacturing arena, these include raw materials. In our little cupcake shop, this was flour and frosting, for example. It also includes labor and manufacturing overhead that is directly utilized to manufacture the product that is sold. Retailers include in cost of sales the purchase of merchandise that is resold. Service businesses include the direct costs associated with services sold to customers. Gross profit. This is the amount of net sales less the cost of sales. This excess provides the resources for the remaining expenses of the company. Gross profit, sometimes called gross margin, when sufficient, provides the funds that flow to the bottom line or net income of the company. Selling, general and administrative expenses. These are the operating expenses the company incurs other than the cost of sales discussed above. Financial analysts closely monitor how these expenses trend as a percentage of sales to provide insight to the effectiveness of management to control operating expenses. This category of expenses can easily inflate over time and become the fat, often referred to that needs to be trimmed for an efficient operation. Operating income. This is also called earnings before interest and taxes, or EBITDA. It is the amount of gross profit left over after the SG&A operating expenses. Thus, it is the amount of profit from operations before costs such as interest, taxes, and other costs not related to the operation of the business. EBITDA, or operating income, as a percentage of sales is widely used as a key measure of the company's efficiency and profitability. Pre-tax income. As the name implies, this is earnings or profit before income taxes. Since income taxes vary widely and can be minimized in many ways, many analysts look to pre-tax income as a better measure of profitability than net income. Net income. This is the true bottom line of net earnings after all expenses, including income taxes. In most cases, this is a net profit, but could be a net loss if expenses exceed earnings. If a corporation pays dividends, the balance of net income after dividends would flow to the company's balance sheet as retained earnings. Earnings per share. This is EPS. These are calculated based on using a net income reduced by any dividends paid. The formula is net income less dividends divided by the number of stock shares outstanding. The resulting earnings per share is a commonly used measure of profitability that is convenient to compare between companies and between time periods. Analyzing the income statement. We've discussed what the income statement is and the components that make up the income statement. Now let's turn our attention to how you should analyze the income statement. That is what you should look for. What is the income statement telling you? Looking at just one period, this is a year or quarter, looking at one period alone is not very helpful. You need to look at and compare the income statements for 2 years. You want to see trends. Is the income statement improving, stable, or eroding? Here is the income statement for a hypothetical company. Now this is Business X, we'll say, for the last 2 years. Business X, income statement, 2011 and 2012, in US dollars in thousands. So what do these 2 years of income statements tell us? First, net sales have grown strongly, almost 19%. That growth has resulted in efficiency in production, which is reflected in the cost of sales declining from 32% of net sales to 30% of net sales. This is a reflection in gain in gross profit from 68% of net sales to 70% of net sales. Additionally, management has maintained a firm control on the operating expenses of sales, general, and administration expenses. These have declined from 17% to 15% of net sales. This carries down to an increase in earnings before income, interests, and taxes from 51% of net sales to 55% of net sales. The growth in net sales combined with greater efficiencies in cost of sales and in operating expenses is reflected in a 29.4% increase in net income. All this indicates a strong and growing company that is in the absence of other issues, should be a good investment. This example, compared to 2 one-year periods, would also want you to compare the quarterly trend to assure that Business X sustains its healthy trend. Remember, Business X does not operate in a vacuum. They operate within an industry segment, and they are only one of several companies competing for business. You should also look at the Business X's industry competitors. It could be this industry is growing overall and Business X is just riding the wave. Or they could be growing and gaining market share while others are falling behind and losing market share to Business X. Obviously, you want to base your investment decisions on as much knowledge as you can assemble. You want as complete a picture as you are able to achieve. So look beyond Business X. Understand what is happening within the industry in which Business X competes. This completes our video on the income statement. We hope you've learned what it is, what makes up the income statement, how it illuminates what is happening within the company you are researching. We have covered a lot as always. We suggest you view this video a second time and take notes. Then pick a company and research it. Research what its income statement to put what you've learned into practice. Then view the video a third time. The more you learn about the income statement, the more accomplished and confident you'll become in using it effectively in your investment decision making, and undoubtedly, the more profitable you will be in investing in general. So good luck.